Hello, everyone. My name is Richard Yarrow. I'm a fellow at the Mosafar Rahmani Center for Business and Government at Harvard Kennedy School. Good morning to everyone in the United States right now, and good evening to everyone joining from Asia, where I currently am located. And thank you for signing up for this discussion, which is being co-sponsored by the Mosafar Rahmani Center at Harvard Kennedy School and the Fairbanks Center for Chinese Studies at Harvard University. This is the second event in a series on understanding changes in China's real estate sector and its broader effects on China's economy. In the last 20 years, real estate has had a growing role or influence in financial flows and balance sheets across China's economy. By some estimates, in recent years, real estate has accounted for or contributed to roughly 70% of household assets, roughly 25 to 30% of local government revenues, and roughly 25 to 30% of all outstanding bank loans in China. Today, China's real estate sector faces a crisis, even while many firms, local governments, and ordinary individuals financially depend on housing values. To help us understand the possible financial repercussions and debt-related repercussions from the problems in China's real estate sector, we are honored to have Michael Pettis and Hui Shan, two excellent, deeply knowledgeable experts on China's economy and financial system. We'll begin this evening in this discussion with their presentations, followed by a moderated question and answer session. Members of the audience may use the Q&A feature on Zoom below to submit questions either by name or anonymously. We are very fortunate as well to be joined by William Overholt of the Mosafar Rahmani Center, who will conclude following the question and answer session with comments on directions and trends for China's economy. And with that, I will let Jinlin Li introduce our excellent speakers.
Hi, everyone. I'm Jinlin, now a postdoc fellow at Harvard Kennedy School. Let me very briefly introduce our two excellent guests and our senior fellow who will conclude the event. Michael Pettis is a professor for finance at Peking University and a senior fellow at Carnegie Endowment. Before moving to China in 2002, Pettis worked on Wall Street, running trading and capital market desks, specializing in developing countries. His most recent book is Trade Wars on Class Wars, published by Yale University Press. Hui Shan is the chief China economist at Goldman Sachs based in Hong Kong. Hui joined Goldman Sachs in New York in 2011, previously working on the global markets team focusing on the US housing and mortgage markets, and the commodities research team heading the metals research. Hui was named managing director in 2019 prior to joining the firm. Hui worked as the economist at the Federal Reserve Board of Governors. Hui had a PhD in economics from MIT and a bachelor degree in science in economics and biophysics from the University of Michigan. William Overholt is a senior research fellow at Mosafar Rahmani Center, Harvard Kennedy School. He was previously president of the Fang Global Institute in Hong Kong, a visiting professor at Shanghai Jiao Tong University, and directors of the Center for Asia Pacific Policies at RAND. During 21 years in investment banking, he served as the head of strategy and economics at Nomura in Hong Kong, and as managing director and head of research at Bank Boston in Singapore. He is the author or editor of 9 books covering Asia's economy and the geopolitics. So without further ado, so let's start with Michael.
Thank you very much. It's a pleasure to speak to this group. There are so many ways we can approach the issue of the real estate market in China. It's a huge problem with lots of different ramifications. So what I thought I would do is start out by discussing a question that I get from a lot of my clients, which is, do you think they'll be able to revive the property market in China? And I'm not sure that's the right question for a couple of reasons. First of all, it depends on who you mean by they. There are basically two types of government in China. There's Beijing, the central government, and then there are the local governments. And it's not clear that there's a lot of agreement between the two on the revival of the real estate market, whatever that means. Local governments have been really badly hurt, as you know, by the collapse in revenues associated with land auctions. So yesterday we had, I think it was the fourth of the 4 land auctions this year. Local government SOEs were able to buy about 33% of the parcels put out for sale. Now, this is a much lower number than what we've seen in the beginning of the year, because basically the Ministry of Finance a couple of weeks ago came down very hard on a game that many of the local governments were playing. They're so desperate for land sale revenues, and there is insufficient demand at these auctions, that they actually created local government financing vehicles, LGFVs, that were able to borrow under the local government credit umbrella, either explicitly or implicitly, and then use the money to bid on the land auctions, right? This is a really big problem, because basically what I'm saying is, I am lending you money to buy something from me and calling it revenues, when in fact, all I'm doing is borrowing, effectively borrowing. So, I'm sorry, I'm not lending you, you're borrowing under my credit guarantee. And this really increased the risk of local governments, because if the real estate market were to revive, this would seem like a really clever ploy, because if real estate prices start to go up again, local governments will have been able to buy real estate cheaply and they'll sell them off at a profit. The problem is that if the real estate market doesn't recover, local governments have basically doubled down on their exposure, because now they have bought land from themselves and recognize it as revenues at a price that will be above the price at which they can liquidate. And most of these LGFVs don't seem to be using the land for development purposes. This is purely speculative transactions. So correctly, the Ministry of Finance clamped down on it. The central government has clamped down on a number of attempts for local governments to get around this real estate problem. And so that's why I would argue that while local governments are desperate to see a revival of the market, it's not at all clear that Beijing is. I think Beijing clamped down on the real estate market. I think they underestimated how painful it was going to be, but they clamped down on it because they very clearly recognized that this market had gotten completely out of hand. Now, can we see a recovery in the market? We might see a temporary one if, when they eliminate the zero COVID policy, God knows when that will be, if they simultaneously implement a number of measures aimed at boosting the real estate market, the combination has to change sentiment. If you look at a quarterly survey published by the PBOC, they actually go out and ask people, do you think prices will go up or go down, real estate prices? And the latest quarterly survey, which came out about a month ago, showed that for the first time ever, more people think prices will go down, or at least the way they respond in the survey, than think prices will go up. And the number who think prices will go down is about 2 or 3 times what it had been even 3 years ago, whereas the number who think prices will go up is roughly a third of what it had been 3 or 4 years ago. So clearly there's been a massive change in sentiment. Now, should prices go up? Well, McKinsey there's a lot of ways to measure the value of residential real estate. And McKinsey had a really good study, which they use a method that intuitively appeals to me. I don't know if there are better ways of doing it, but what matters is really the direction. And what they showed was that typically over time, until very recently, the value of residential real estate globally and in most countries was a little bit above 100% of GDP. That seems to be the sort of a sustainable level. That doesn't mean it was always 100%. In Japan in the 1980s, it soared above that level. In Spain and Ireland, in the period before the financial crisis, it soared above that level, but those were always temporary. It always eventually returned. Now, the McKinsey study was very worried about the fact that in the last 15 years, we've seen a shift. The total value of real estate, residential real estate, is now roughly 120% of global GDP. So their argument is that either something fundamental has changed in the real estate market, or perhaps more likely, we've gone through this long bubble in real estate, in which case we should expect some kind of correction. Fine. But in China, the value of residential real estate, again, depending on how you measure it, is something like 350% of GDP. It's roughly 3 times the share of GDP of what may be an overvalued real estate market in the rest of the world. And this clearly creates real problems for China. As you know, very, very high real estate prices have been blamed for a whole number of things, including an excessively high household savings rate. So it's not clear that Beijing wants to see real estate prices recover. I think they're very nervous about a collapse in real estate prices, and they will probably take steps to prevent a rapid decline. But I would really hesitate to think that Beijing also, like local governments, wants to see a short-term recovery in real estate. Now, can it recover? Even that's really questionable. Chen Long at Plenum, one of my favorite Chinese research groups, did a study quite recently, which he presented to a group of us at this regular meeting we have every month at the IMF, in which he tried to estimate over the rest of this, or over the next 10 years, the total demand for new apartments in China, the sustainable demand. And he made a number of very generous assumptions. He assumed that what do you need to do to make, to estimate a future demand for apartments? You need to know the growth rate of the population, and we have pretty good data on that. You need to know the urbanization rate. And he assumed rather heroically that Chinese urbanization would continue at the same pace in the next 10 years as it did in the past 10 years. I think that's heroic because we know as the urbanization rate goes up, it has to slow down because at 100% it becomes zero. But he said, fine, let's assume it continues going up as quickly as ever. And he assumed that household income would continue to rise at 6 or 7%, which is very circular because if the household market continues to go up, that probably means that household income will continue to go up. But if there's a problem in the economy, both are unlikely to go up. But anyway, he made that assumption. And what he came up with was the amount of apartments we needed every year. And again, by the way, all those empty apartments you've heard about, 20 to 25% of apartments are empty. He assumes that Chinese will continue holding the same rate of empty apartments as they have in the past. That's a super heroic assumption because the reason you hold an empty apartment is because you expect rising prices and you eliminate the expectation of rising prices and an empty apartment becomes a negative carry. And so you're unlikely to want to hold it. But he said, fine, let's assume there's no change in the tendency of Chinese to hold empty apartments. Adding all of that together, he came up with a sustainable demand of something like 20 to 30% below what property developers have been adding to the market every year prior to last year, of course. So it's very hard to argue that there is anything that can sustain the property market. It's way overvalued. To the point where it's created significant economic problems, and Beijing would like to see that overvaluation resolved. And the demand for apartments, the only way it can be maintained at anywhere near previous levels is on the assumption that people are still buying apartments primarily for speculative purposes and not for living in them. So I think it's very unlikely we'll see a recovery in the property market. And if we do, as I said, it'll be very temporary as a reflection of a whole bunch of events next year. So how does that impact the overall economy? Well, as Jinlin mentioned, the problem in China The problem in every country is that the property sector is very important, and any slowdown in the property sector inevitably impacts the rest of the economy. But as Jinlin mentioned, in China, it's not even comparable to other countries. The total household savings, the property component, the estimates are between 60 and 70%. I think that's roughly twice what it is in other countries. And the only country I could find comparable, you will not be surprised to hear, was Japan in the 1980s, when a significant portion of savings consisted of equity in real estate. And why does that matter? It matters because of the wealth effect, right? What the wealth effect is that as your wealth goes up, you tend to consume a larger share of your income. And as your wealth goes down, you try to rebuild your savings by consuming a smaller share of your income. So the concern there is that if you see a decline in property prices, that will show up not just in the property sector and upstream and downstream industries, but also in overall consumption. People will feel poor and consume less. Over the long term, that's not necessarily the case, because those who own apartments will feel poorer, but the young, the unemployed workers, the poor who are effectively short real estate, they will benefit. But the cost, it's very convex. The cost occurs, or negative convexity. The cost occurs all upfront and the benefits occur in the future. So it's got to have a negative impact on the economy. And then there's the direct impact of the property sector. In the average investment share, I think I'm probably only have a couple more minutes, but the average investment share of GDP around the world is about 25%. And you have mature economies, the US, et cetera, where investment is around 20%. And then you have rapidly growing developing countries in the midst of their growth booms, where investment is around 30 to 33%. In China, investment is an astonishing 42%, right? Before China, I think the highest investment rate we ever saw was around 38, 39% in South Korea for a few years. But China has been between 42 and 47% for more than 20 years. It's really astonishing. And out of that, you can broadly divide investment into three groups. Roughly 1/3 goes into infrastructure, 1/3 went into property, that's coming down, and 1/3 was largely private sector investment in manufacturing. And that gives you an idea of just how big the problem is. The investment share of GDP, the property investment share of GDP is 14 percentage points, which is almost equal to total investment in many other countries. So any slowdown in the property sector represent a significant slowdown in that component of GDP. And in addition, because investment is, again, the numbers vary, but typically we talk about 25 to 30% of economic activity. Any slowdown in the property sector will have really major impacts on overall economic activity, which becomes self-reinforcing, because when it's big enough, it starts to affect other activities. If you fire lots of people in the property sector, they'll reduce their consumption, and then people in the restaurant sector, et cetera, will also suffer, and so on. So it's a very tough problem for China to resolve. And by the way, in my opinion, there is no resolution. After 20 years of constructing the economy around a booming property sector, there is going to be a very, very difficult adjustment. And the question that we should be asking ourselves is not, is there a way out, but rather, what is the least difficult adjustment they can go through? Let me stop there.
Thank you, Michael, for the insights. Of course, there's much more to be discussed, maybe in the Q&A session. Then let's turn the floor to Hui.
Thanks, Jinjin, and thanks for having me. Let me pull up my slides. Okay. Yeah, I think it's good to be following Professor Pettis. I think a lot of his views, we share similar views on China real estate sector. I think the following 15 minutes, what I'm going to do is perhaps provide a bit more color based on our own research, sort of to complement what Professor Pettis laid out as his overarching view on the current state and sort of forward-looking, how does that play out in China's property market. This slide echoes what Professor Pettis was saying, that China is investing a lot in its real estate sector. What this chart is showing on the x-axis is population growth, and on the y-axis is residential investment as a share of GDP. So you can see that across the international data, China in 2020 was investing a lot in its real estate sector as share of GDP, especially compared to its population growth. Now, if you look at the forward population growth picture, 2022 by UN projection, China may be having outright population contraction. So if you put your sort of the scale down to around 0, then international experience suggests China should be having about, let's say, 5% of GDP in the real estate residential investment sector. But as of 2020, it was over 10%. So this illustrates China as a bit of outlier in international comparison, just how big the residential investment as share of GDP has been. I think this chart is similar to what Professor Pettis was saying about Chen Long's calculation. So the goal is very similar. We want to quantify how many apartments China needs to build each year based on underlying demand. So when we say underlying demand, what are these demand? Well, the dark blue bars are the demographics. There are 3 pieces of demographics that we are incorporating here: population, urbanization, and household size. So obviously, we are looking at urban housing demand. So population and urbanization rate makes sense. We're using the sort of medium forecast from the UN population projection here. And household size, because if you have 100 persons and each one of them wants 1 unit of apartment, then you need 100. But if they all get married and 2 people living in 1 unit, then you only need 50 units. So that's the idea, that household size also matters. And looking at experience of developed countries, you see that household size declined over the different phases of a development, and we're using South Korea, Japan experience to extrapolate how the average household size in China is going to play out going forward. The middle light blue bar, those are the replacement demand, that if the housing stock, some of the units are really old and not suitable for living in, then you have to demolish them and build new ones. And that creates demand for new construction. And you can see around 2015 to 2018, the shantytown redevelopment boosted the demolition demand for housing. And then the gray bars are the investment demand. So this gets back to the question, those empty apartments, some of them may be purely investment, but some of them could also be investment in the sense that if you are a migrant worker, you live somewhere in the top tier cities, but you also have an apartment in your hometown, just in case during Chinese New Year, you need to go back and you want to have a place to live. Or just have your savings allocated into property sector. So for whatever reason, there is going to be some investment demand, and we let that gradually decline in the coming decades. Now, a lot of assumptions are made in making these calculations. For example, different age of a housing stock is going to depreciate at different rates. So you can change the rates to change your replacement demand. Nonetheless, I think the conclusion is quite clear that between 2010 and 2020, we calculate that China needed to build about 18 million units of apartment per year, whereas fast forward to 2050, you only need 6 million. So from 1.8 to 6, that's 2/3 of a contraction over the next 30 years. Ideally, you want to engineer a soft landing by declining, say, 3% per year from 2020 to 2050, you can get there. But being in China and the policy coordination was not ideal, and we saw much sharper decline over the past 18 months. The next slide, I want to show a bit of the housing connection to GDP. This is another aspect that Professor Pettis mentioned, and we did a calculation. If you look at residential building final demand, so that would incorporate all the steel and cement going into it, that's a 12.4% of GDP. And then you add the real estate service industry, you get about the 18% of GDP. Now, if you think some of the non-residential building, malls, hotels, cinemas, though they are related to residential, then the number would be bigger. But we would just say that sometimes we see people throw out numbers like 30%, just adding total construction final demand with the real estate service 7.4. That's a bit exaggeration when you look at the data more carefully. Nonetheless, I think the conclusion is that real estate sector is important in the economy. Now, if we translate both how much demand China needs on housing with the linkages between housing and GDP, then we can get estimates. How does China's property deleveraging going to impact GDP? So in this chart, we try to do that calculation by taking into consideration the different channels through which property is linked to the real economy. Certainly, there's a construction, there's a consumption, wealth effect, confidence effect. There's a fiscal channel because local governments rely on land sales revenue. There's real estate services, and the upstream effects, it just means we use input-output table to figure out the multiplier effect. Again, that's the steel, cement going into your construction. So if you add up all those impulses and sort of figuring out what does the future hold for housing contribution to GDP and what does that mean for China's growth rate going forward, two conclusions here. Number one, in terms of China's growth rate, if you think 2019 was the normal rate of growth, 6%, and this chart is telling you out of the 6%, 1 percentage point is coming from housing. Now, if you believe in this chart and take an average of the next few years, it's going to be subtracting 1 point from your GDP growth. What that means is that growth should be around 4%, all else equal, if you were a 6, but now housing turning from a +1 to a -1. The second point is that because we had such a sharp contraction in the housing sector this year, and because housing is a long construction cycle, so the starts you didn't have this year going to translate into lower under construction stock next year. This is going to drag on for a few years unless we see the government does a U-turn, we do a complete reversal of the housing deleveraging, which we don't think is likely. So this is telling you the drag from the property sector to GDP is going to last for a while. I have 2 more slides. I want to turn from a longer term and structural issue that Professor Pettis mentioned. I also want to provide our research analysis to support his views. Turning into a more near term, what the government needs to do, what's the risk remaining in the property sector, even after such a big correction. Number one, what we have been observing is this private developers of financing sources being pretty much shut down. What this chart is showing you, the dark blue line is SOE, state-owned enterprises. The light blue and the gray are the private developers. And the numbers are showing you their pre-sales, their property sales as a percent of what they were selling in mid-2021 before this huge contraction in housing activity. So you can see the SOEs are still doing okay. They're selling about 70% of what they were selling before the big drop in housing activity. But look at the gray line, they're only selling 18% of what they used to sell. These are the POEs that already defaulted or exchanged their bonds. So this is from our credit strategy team. Look at these developers who have dollar bonds outstanding. So what this chart is trying to say is that the financial market shut down financing and funding for POEs. But if you think the SOEs can take over POEs as a solution, then it's quite challenging when you look at the market share, because before mid-2021, when you look at the composition of the sales, private companies, private developers account for 2/3 of the market. So if you're trying to let 1/3 of the market to take over 2/3 of the market, it's going to be challenging. The second near-term concern that we have is that even though the government has been saying we want to provide financing to ensure the delivery of pre-sold homes, if you look at the developer's balance sheet, what you discover is that the pre-sold unfinished projects are only about half of what's under construction but not sold. What this means is that the government's efforts to ensure delivery is really just about those that's already been sold. But what about those unsold properties? The developers won't have the financing to finish them. So you're going to have all of these property projects that are half built or not built at all sitting there. So in other words, this is still an unresolved problem imposing near-term downside risk to our growth outlook that hopefully with the new set of government officials and economic policymakers can provide a more coordinated and holistic solution to the situation. Let me stop there and hand it back to Jinlin.
Okay, thank you to both Hui and Michael for the excellent presentations and remarks. We'll now begin with the question and answer session. And while members of the audience are thinking and typing up their questions, we'll start with a few questions previously submitted on the registration form. So to begin with the first question, to what extent is China's economy experiencing debt overhang related to the real estate sector? And how might problems in the real estate sector affect more innovative sides of the economy, such as the technology sector, if at all? Anyone like to begin? Oh, unmute.
I think you should assign somebody, Richard. Otherwise, we'll spend a long time waiting to see. Hui will wait for me and I'll wait for her.
Michael, I will assign you then.
Okay. I'm sorry, repeat the question.
To what extent is China's economy experiencing debt overhang related to the real estate sector? And how might problems in the real estate side of the economy affect more innovative sides of China's economy? If
well, you know, what's interesting to me is not that, you know, they're experiencing debt overhang. They have for many years. What's interesting to me is that within policymaking circles, sometimes explicitly, but certainly, you know, behind the scenes when you're having a beer with someone, there's a recognition that there's a serious debt problem. But the way I look at it is you know, the Chinese growth model, as I never tire of repeating, is not particularly Chinese. A lot of countries have followed this similar high savings, high investment model, and they all seem to run into the same problem, and that is that when you have a successful growth model, as Albert Hirschman reminded us way back in the 60s and 70s, by definition, a successful growth model becomes obsolete because it's successful to the extent that it addresses the underlying imbalances within the economy. And once those are addressed, it's no longer a useful model. So what we've seen in every country that's followed this high savings, high investment model is they always seem to follow a similar path. They start off with very high investment needs compared to their actual investment levels. So a high investment model is exactly what the doctor ordered. Growth accelerates, and it's all healthy, sustainable growth. And then at some point, something seems to shift. And in retrospect, we always know that growth was very high, but it was no longer sustainable and no longer healthy growth. And I would argue that we can see where that shift takes place. We saw it in Brazil in the early 70s. We've seen it in lots of different places, Japan in the early 80s. And that is that by definition, when most of your debt goes to fund investment, and in China until recently, there was very little consumption debt, it was all investment debt, then debt can rise quickly, but you never notice it because GDP is rising just as quickly. That's the definition of productive investment. The value it creates for the economy is greater than the cost and resources. So your GDP grows at least as quickly as your debt. And in the 1990s, debt grew very quickly in China. We just never spoke about it because GDP grew just as quickly. But something changed in 2006, 2007, 2008, and we started to see the growth in debt accelerate and the growth in GDP slow down. Now, that can happen over short periods of times, but that cannot happen over long periods of time if your investment continues to be productive. That can only happen when you are borrowing $100 to create something that over its life adds whatever, $60 to the economy. That's when you start to see the debt to GDP ratio take off. And that's, we saw that maybe 14, 15, 16 years ago. And it was growing very, very rapidly. And I think it became pretty clear by 2010, 2011, that there were two main sectors driving it, infrastructure and the property sector. They were both very necessarily in the early stages of the growth, but they both became the big sources of explosive growth in debt relative to assets. So I would argue that, yes, there's a debt overhang. Yes, it's driven by the property sector. Unfortunately, it's only one of the two major sources of non-productive investment in growing debt. And I think infrastructure may be a bigger problem than the property sector, but we'll see. But yeah, and that's going to continue until they rein in those two sectors.
Excellent. Hui?
Yeah, sure. I guess I just add a couple of points. One, in terms of, I think the question is a bit of upside down in the sense that the reason why the government is so determined to crack down on property and to delever this sector is because all the money that the government would like to see going to manufacturing innovation were sucked up by the property sector. So in a sense, by cracking down on the property sector, the hope or the theory is that they can allocate the capital to the more productive sectors, whether or not and to what extent this is efficiently executed, that's another question. So it's not so much of the property sector deleveraging could have a negative impact on other sectors. Is more by design. They want to direct the flows to these strategic or areas that the government would like to grow. The second point I would make is that if you told me a year or two ago that the housing market is going to contract to the extent that we're seeing right now, the starts down 40% and sales down 30% and then sales down 50, 60%. I would have thought we're in a financial crisis, just given how important the property sector is to China. But if you look at the credit market, it has been remarkable that outside of the property sector, credit spreads are well behaved and there's not much of a financial stress that we can detect the intermarket liquidity and intermarket rates well behaved. So far, the government seems to be succeeding in controlling the property sector without bringing down the entire economy. But we'll see. It's still early in the game. The private developers, almost all of them are having trouble getting financing. So there's still risk to the downside. But so far, it looks like if you're a tech sector or other sector, if you want to get financing, you might get difficulties from zero COVID or other problems, but not from the property sector yet.
Thank you. Before we move to the Q&A chat box, we still get a question from the registration form about the property tax. So we all know the property tax could be a remedy for the declining land sales. How would the property tax affect that risk in the real estate sector? So faced with the dilemma situation, do you think Beijing will start the property tax sometime soon? So this is a question for both of you.
Michael, do you want to go first, or?
You want to start first, Hui? I did last time. We can switch on and off.
Yeah, sounds good. I think eventually, the housing for living in, not for speculation, is a part of the common prosperity. I think that's the direction of travel. But given the dire situation in the property sector right now, it's not the time to introduce property taxes, because that's going to increase the incentive for all those empty apartments to come on the market, which could drive prices significantly down, and then banks have to mark to market. We could get into a spiral. But eventually, that is the direction that we need to, if we're really serious about housing for living in, not for speculation. Whether that's in 5 years or 10 years, I don't know, but that is what the policymakers have been thinking about. But the second point being, property tax is not the sort of magic bullet. You look at the magnitude of land sales before the recent downturn. Local governments sold about 8 trillion RMB of land a year. Whereas when you look at how much property tax can collect at reasonable tax rate compared to household income, we estimate maybe 1 trillion RMB. Because the reason is that in China, the income is not that high, so property price is so high. So you can't really increase the property tax rate very high, in which case the household is going to allocate too much of their income just to pay property tax. So if that's is 1 trillion going to cover that 8 trillion? No. Then how are you going to solve this whole fiscal problem of local governments relying on land sales for their finances? So I think it's a deeper question, the division of revenue versus spending responsibility between central and local. So to conclude, I think property tax is the direction we're heading into. And second, just by imposing property tax, it doesn't solve all the problems. Michael, over to you.
Yeah, it's really hard to get good debates going on China anymore, because everybody agrees. The problems, I think, are quite evident. It's hard to find a huge variety. I would argue that it's almost impossible to impose property taxes, and it'll be quite a long time before they do, for the reasons that Hui mentioned. Maybe because I was a bond trader for such a long time, I think in terms of carry. And when real estate prices were going up, many apartments were empty, and even the ones that were rented out, as you know, rental yields in China are incredibly low. Jinlin mentioned that he had been to my courtyard house. I wish I owned it. It's worth far more than I could ever afford, but I can afford to rent it because rental yields are so low. And that's very important, because you don't own apartments to rent them out because the rental yields are negligible. You own them because of their appreciation value for the most part. And there's a little bit of a negative carry, and that is the depreciation in the value of housing stock, but it's quite low. And as long as prices go up by more than the cost of financing, you're ahead of the game. Well, prices are no longer going up. And if you impose a property tax, a meaningful property tax, you're immediately creating negative carry, right? So if you own an empty apartment, what do? You've got to rent it out. Otherwise, you're losing money every year on the negative carry, plus prices are going down, a double whammy. But if you were to take even half of these apartments and rent them out, that increases the amount. I don't know what it increases the rental amount by. It could increase it by 50, 60, 100%, but it'll put even further downward pressure on rental yields, which will make the whole carry more complicated. So in the end, the only thing you can really do is sell your apartment. And of course, if you sell the apartment, you put more downward pressure on prices, and more downward pressure on prices increase the tendency to sell, right? It's a classic speculative market. You buy because you expect prices to be higher tomorrow than today. You sell because you expect prices to be lower tomorrow than today. They should have implemented property taxes 5 or 6 years ago, because that would have slowed down the increase in prices. Now, all it will do is it'll accelerate the decrease, and I don't think they want to do that.
Thank you. We now have many questions in the question box, and we'll try to get to as many as we can. The first question we'll take is from Saul Wilson in the Harvard Government Department and at Brown University. And he asks, what can households do with their money now that housing may no longer be a good investment? In particular, can we expect households to move towards consumption or to seek out other investments? And if investment, where can we expect this money to flow?
Shall I start?
Yes, Michael.
If people stop saving in the form of housing, they are very unlikely to shift that to consumption. On the contrary, consumption may even decline if housing prices decline because of the immediate wealth effect impact. What I suspect that Chinese will do, ordinary Chinese, they don't have that many alternatives. Housing, if that no longer works, stock markets have been incredibly volatile. They're unlikely to invest there. So they'll probably move their money to the banks. And we're seeing that already. We're seeing a shifting of savings away from wealth management products, stock market, et cetera, into bank deposits. And I think we'll just continue to see that. I really don't think there are alternatives. Richer Chinese may buy more collectibles, gold, jade, art, stuff like that. But for ordinary Chinese, there are not many alternatives.
Yeah, I agree with that answer.
Very fast response. Maybe next we'll go to Enrico Fardalla at John Cabot University. He asks, in these overinvested models, do we have successful exit strategies applied by other countries in the past that can be used by new Chinese leadership as a successful solution to China's current economic difficulties? Hui, would you like to begin?
Is this for overall Chinese economic growth model or for property?
I think particularly in property.
I mean, the Chinese scholars have spent a lot of time looking at the experience of Japan and how not to repeat Japan's policy mistakes. But the current round of tightening, just given how much the market has contracted, it does raise the concern of whether or not the government is tightening when things are already slowing and continue to tighten on multiple fronts, the 3 red lines on the developers, the 2 red lines on the banks. And it's a situation where, you know, is there a good example in other countries' experience? It's hard to see. It's just so unique a system. But in terms of cautionary tales, I would think Japan would be a cautionary tale that if you tighten the market, it's already showing signs of softening, but you don't stop, you keep tightening it. Just given how much momentum the property sector tend to display. It's not just stock market going up and down from one day to the next. There is a risk of over tightening, and when you finally decide to ease, it's too late, especially given the demographic and fundamental demand backdrop. Perhaps Professor Pettis will have more to add on that.
Yeah, when you look at historical examples, there are no good answers. And the way I think about it is there's really only three ways that China can proceed. Remember, they've got an extraordinarily high investment share of GDP, including in the property sector. That has to come down, and it must be replaced by consumption. China's too big to depend on the trade surplus. So there are three ways that the consumption share of GDP can grow. One way is something happens that causes consumption to grow 6 or 7%, and it pulls GDP behind it at 4%. That's theoretically possible if the government were to transfer between 1 and 2% of GDP every year from local governments to the household sector. They could, in theory, pull that off. It's incredibly difficult to do that, and no country in history has managed this. I'm a finance and economic history junkie, and I've been looking for examples of country that followed this model that got out well. I haven't seen anyone that managed that kind of adjustment. The second way you can adjust is the way the Japanese did. GDP growth drops substantially from 4 or 5% to basically 0.5%. Consumption growth and household income growth drop a little bit from, say, 3% to 2%. And over 20 to 30 years, Japan has still been adjusting at very slow growth rates. And then the third way you can adjust is what I call the US way, which is what happened to the US in the early 30s. GDP contracted by 35%. Household income contracted by half of that, 19%. Brutal adjustment, but very quick. And once again, the household share and the consumption share of GDP expanded. Those are literally the three ways you can do it. But the first way, the good way, has never been done. So that doesn't mean it's impossible, but it's quite difficult to manage this adjustment.
All right. We also get a question about the rental activities in Shan at MIT. So can you provide assessment of the behavior of the rental activities in the Chinese real estate market regarding the property investment? So do we see an increase in the rental activity that crowd out some of the property sales? Will be more people start to just rent house instead of buy the property?
I don't really have an answer to that. Hui, maybe you do?
Not quite sure about the question. That do we see more renters crowding out owners? I mean, only marginally, right? We are seeing some mortgage boycott, and meaning that they are, if you're paying both the rent and your mortgage, and now you don't know if the property is going to get delivered, you stay put as a renter. But that it's I mean, in China, the sort of the preference for being an owner, this is partially why we see these empty apartments not being rented out. We see people just try to stretch and save a lot just to become a homeowner. And in urban area, outside of the top tier cities where the affordability becomes so stretched, home ownership rate is being generally very high. So I haven't, I guess my answer is I haven't seen dramatic changes in the rent versus own decisions.
Thank you. Next, we'll go to a question from Yuhao Wang at Harvard. How would the risk heterogeneously impact different tiers of cities? Particularly, what would signal that tier 1 cities are at risk?
Michael, you want to take this?
Sure. I think that could be one of the most important questions politically for China in the next couple of years. I don't know what signals to look for problems in the tier 1 cities, except to look at property prices. I think the secondary market is going down. Primary market isn't, but we're very nervous about primary market data because there are a lot of restrictions on your ability to show lower prices. So for example, if a house is worth $1 million and I can't sell it, I won't lower the price. I will sell it at $1 million, but give you a free BMW if you buy it, or something like that. So it's sort of hard to look for signs. But for me, what's interesting about this question is that it acknowledges that there are two very different Chinas, right? There is the China of Shanghai and Zhejiang and Guangdong, you know, the 5 or 6 best provinces that represent maybe half of GDP and maybe a fifth or a fourth of the population. They have debt problems, but not terrible debt problems. They have growing economies. They have growing working populations. You know, they're in reasonable shape. And then you have the rest of China, which is in serious trouble, enormous debt problems, unrepayable. There's no way they can repay them, stagnating economies, and they're bearing more than 100% of their share of the demographic problems because all of their, you know, educated kids, as soon as they get out of high school or college, not all, but a lot move down south. So they have terrible demographic problems. I don't really know how you resolve that, but it seems to me that that has to be one of the most interesting conflicts that will determine how China evolves.
Okay, so let's quickly ask the last question and give the floor to Bill. This question is a relatively broad one. So he want to this question is about the probability that China will face the financial crisis. He said, when I was in Beijing 8 years ago, Chinese government official points out that loan to value ratio is only 60% and no way to become financial crisis. What's the situation now?
I can start. I guess that, you know, even if there is a financial crisis, it's not the same nature. And as a question framed, the down payment requirement is very high. So it's not really about negative equity and sort of that type of trigger. And, you know, recently the city of Zhengzhou cut down payment requirement for second homes from 70% to 40%. That tells you, like, even after easing, you still have to pay 40% on down payment for second homes, and first homes 20% minimum. I think that what I worry about, sort of related to our discussions earlier, is the stock of units. Right now we have the flow of new construction contracting sharply, but the stock is still okay. We haven't seen people with multiple apartments are selling, and but if that were to happen, if we see all these you know, secondary market, a huge increase in supply driving down prices, that could be impacting the entire stock and impacting the bank balance sheet, impaired lending capacity. So all that is a concerning. That could be the sort of the triggering of so-called financial crisis, not the sort of down payment negative equity. And to avoid that, managing price expectation, this is related back to the property tax question. You got to make sure people's expectation about prices are not dramatically changed, and thereby triggering the problem with the housing stock.
So on to Michael on risks of financial crisis.
You know, the whole loan to value argument is nonsense. It's totally circular, right? Loan to values are great as long as value doesn't go down. And the moment it goes down, it's a huge problem. So everything is fine as long as everything is fine. But having said that, China is very unlikely to have a financial crisis. You know, a financial crisis is a balance sheet problem. It's caused by mismatches between assets and liabilities. And you have a contraction in the liabilities that can't be matched by a contraction in assets, and the whole thing falls apart. You have financial distress, et cetera. In China, balance sheets are horribly mismatched, but it's a closed system. The banking system is administered. It's not a market system. It's more like, again, Japan in the 80s with its window guidance. And most importantly, the regulators can control the structure of the liabilities. So while on paper it looks mismatched, they can always restructure liabilities, and they've done that. They did that with Baoshan Bank. They did that with Huarong. They do it over and over again, so that you never have the equivalent of a run on the bank. Is this a good thing or a bad thing? Well, in the long run, it's probably a bad thing, but in the short run, it's probably a good thing. They are very unlikely. It's not impossible, but they are very unlikely to have a financial crisis in China.
Thank you to our two excellent speakers, Hui and Michael, for their very insightful remarks and comments. We now turn to Bill Overholt to give concluding analyses of what to make of the economic effects and risks around Chinese real estate. Over to Bill.
Well, I have to start by just expressing appreciation for two brilliant speakers. And all the questions were right on target. So what I'd like to do is step back and address three issues. Why did the property bubble become so bad? Why didn't the property bubble become much worse? And where is this property bubble in the longer span of Chinese development history? So how did it become so bad? If you go back to, for instance, the Jiang Zemin era, watching China's financial leadership monitor potential bubbles, for instance, in the Shanghai property market, it was just remarkable how incisive and how effective they were. I often thought that if the US had just had Zhou Xiaochuan instead of Alan Greenspan, maybe the US would not have had the 2008 financial crisis. But successful economic growth makes economies much more complicated, and management methods have to change. Other economies, Asian miracle economies like South Korea and Taiwan, faced a crisis of economic complexity in the 1980s, and they drastically changed to more market-oriented economic management methods. China announced in 2013 what sounded like a decision to move in the same direction, but instead seems to have doubled down on the old, more centralized management ways. For instance, as Ken Rogoff and Yang Yuanshan have shown, the current crisis of overbuilding in tier 3 cities is a major government policy error of a kind that never occurred in the previous era. So there's a failure to move with the economic complexity to a more market-oriented management style. I also think that it's probably become politically much more difficult in the new century to manage the bubble, in addition to local government finances being totally dependent on the property sector. The senior political leadership of the country now coincides with a wealthy property owning sector to an extent that I think is unique in the world. And that probably makes the kind of interventions that we saw in the earlier era much more difficult. So second, why isn't the crisis much worse? Remember that in Japan, at the peak of their property bubble, people wanting to buy a house had to accept a 3-generation mortgage. They had to obligate their grandchildren to pay the mortgage. How has China avoided that? Well, China avoided that because under US and Japanese pressure, a wise Chinese financial leadership moved to market currency levels much earlier in historical terms than Japan did. If China had not done this, trade surpluses would have been much larger. The foreign exchange reserves would have grown much higher. China's money supply would have expanded much more, and that money would have been channeled into the property sector. And Chinese families would be accepting 3-generation mortgages. There's a great irony here. Chinese political scientists denounced the US pressures for a market level currency as an attempt to destroy China, as they argued the US destroyed Japan with the Plaza Accord. The Japanese central bank patiently explained to Chinese financial leaders that that wasn't the right analysis, that Japan's problem was that it didn't move its currency to market levels much earlier. Japan's central bank even embedded one of their experts for 3 years in People's Bank to explain what really happened in Japan and what China needed to avoid. Fortunately, Chinese financial leaders listened to the advice, and this saved China from a much, much more catastrophic property bubble than it has already experienced. Finally, where is this housing crisis in a longer term historical context? Well, China's economic miracle has been driven by 3 engines: property, infrastructure, and urbanization. All 3 of those exhaust themselves in this decade. Property is the first to top out. The other 2 will top out soon. The government is boosting GDP in the face of the popping of the property bubble, partly by further inflating an infrastructure bubble. The explosion of excess supply, heavily concentrated in Tier 3 cities, reflects mistaken assumptions about how the last phase of urbanization can be managed. So the property crisis is the first sign of the exhaustion of the drivers of miracle level economic growth. Potential replacement drivers will not provide such spectacular growth. We've seen that in all the other Asian miracle economies. The debt from the property and infrastructure excesses will have to be serviced for decades. The infrastructure will have to be maintained at huge cost that probably is not accounted in most economic forecasts. So China is headed into an entirely different economic era, and this property bubble bursting is just the first wave of a tide that's shifting. Thank you.
Richard, mute yourself.
Hello. Thank you so much, Bill, for those excellent and incisive closing remarks. There's so much more to discuss about an issue as large and weighty for China and the world as the real estate sector and its effects. But for now, we will conclude until the next session of this series on the economic implications of China's real estate sector. I'd like to give very warm thanks to Hui Shan, Michael Pettis, and Bill Overholt for their very insightful, very knowledgeable remarks. And I wish all of our attendees a wonderful rest of the day and evening. Thank you.
Thank you very much.
Thank you very much. Bye-bye.